Welcome to It's Your Wealthy podcast edition. I'm certified financial planner David Somerville. I'm joined today by the heavy brain trust of Capital Wealth Management. I'm joined to my direct center, Jason Pollock. Jason, Happy New Year. How are you?
All is well. How about you? How was your holiday season?
All's good. Back to 2026.
Yeah.
Here we go. Right,
Back to
25's
the
in
grind.
the books. Life is all good, and we're joined by our newest addition, Cody Miller. Cody, how are you?
Excellent.
Welcome to the show. Cody's he's the man, Jason.
That's right.
We brought him in for all the heavy questions and all the
Designated hitter
answers, right? On today's episode, folks, we're going to talk about 2025. It was a great year for investors again. We're going to get into what happened in 2025. We're going to talk a little bit about 2026, what we expect, what we hope, what we pray for. But guys, 2025, again, another great year for the stock market. And you think back to even 2020, we had COVID and people were worried about the stock market. It had a big correction. Don't worry, stay the course. Market comes back. 2021, we have COVID part 2. Stock market goes down. Don't worry, stay the course. Markets come back. We had that 2022 correction, so we had the little bit of the hangover effect from 2020 and 21. But then again, we had a strong year in 23. We had a strong year in 24 and a strong year in 25. So Jason, it's been a great time.
Yeah.
If you're an equity investor in these current days.
Absolutely. The last 3 years have just been outstanding numbers, right? And, if you want, we'll go through them right now.
Absolutely.
So the TSX this year had an incredible year, 2025, 31.7% increase over 2025.
That's crazy.
And as you mentioned,
31%.
31%. Right. The banks performed well. A lot of the oil and gas and a lot of the telecoms, they did really well this year. And as you were talking about, the last 3 years, just a 3-year rate of return just in the S&P TSX, the Toronto, 21.4%.
But even the 5-year, Cody, on this right now, you're looking at it right now, the 5-year return on the TSX composite is just over 16%. I mean, 16% is spectacular, considering we've gone through COVID 1, COVID 2, we had the Russian invasion in Ukraine,
Liberation Day,
like all these things that have happened. Yeah. The market keeps plowing forward.
Yeah. It's been a wild ride, and you know what? I think one of the things we talk to a lot of our clients is volatility. It's always going to be wild. There's always going to be some ups and downs. Liberation Day tanked the market in the first part of 2025, and look what we ended up with, a 31% rate of return.
Exactly. The key thing is you just got to stay involved and stay invested and let things work itself out.
Yeah, exactly. Some of the other returns, the S&P was up only 12%, 12.4%. The NASDAQ was up again, of course, but up only, when I say only, 15.5%. Europe did really well this year, up 25%. And interestingly, bonds, like the overall world bond market, only made about 2.6% this year. So if you were invested heavily in bonds, very safe, secure asset class, you didn't perform very well this year.
So Cody, how do you think clients that own bonds are feeling these days, knowing that these returns were out there?
I think sometimes the risk is not necessarily safety, right? Sometimes there's opportunity cost to playing it a little bit too safe, and you end up missing these really great tidal waves that really bolster the portfolio by not taking on the right opportunities at the right time.
Well, you think about it years ago. I mean, I can remember a few years ago that clients would come in and, and after 2022, I mean, they had a good 21, a good 22, but then there's a little bit of a hiccup a good 20, a good 21. A bit of a hiccup there in 22, and they get a little bit nervous. Maybe the markets went down 7 or 8, 9, 10%, and then they wanted to go to GICs, lock into GICs for the next 3 to 5 years at 3, 4, 5%, and that was maybe not the best decision. Now heading on to 2026. Now we don't have a crystal ball, obviously. I wish we did. Life would be a lot easier, guys, if we had a crystal ball. But there were some predictions out of the U.S. and with regards to the big daddy, the S&P 500. So Bank of America is predicting in 2026 about a 3.5% return. The HSBC Bank is predicting about a 9% return. JP Morgan is predicting a 9 to 16% return. So there's a bit of a leeway there for them. Morgan Stanley's predicting about a 13% return. And Deutsche Bank is predicting about a 16% return. So, if you look at the average return of the S&P 500 over the past 30, 40, 50 years, it's about 9%, 8.9% to be concise. So these returns are floating in that, that 3.5 to 16% range. I would be extremely happy if we we'll take the 9%.
Yep.
Right. 9's not a bad thing, but again, you don't know what's going to happen next or this year, obviously, but pretty bullish predictions. And I think, Cody, one of the reasons why we're so bullish is because of earnings, right?
Well, earnings are going to be what really bolsters that growth, right? So one of the things that we look at is when we know that we've got, one of the big things we hear about right now is AI bubble, right? Are we in this issue with, too much hype, too much, potential bubble opportunity? But really what we keep looking at is the earnings are supporting that growth. And that's what we're going to continue to focus on in 26.
Well, the old saying is that stocks follow earnings. So if earnings are going to be strong, then stocks will hopefully follow. Now, for full disclosure, we've been hearing from different sources that there may be a few hiccups along the way. So if we're sitting here in April or May or June and there's a 5-10% correction in the stock market, and again, for investors that we work with, when you hear about a 5 or 10% correction in the stock market, it doesn't mean that you lost 5 to 10%. Based on a diversified portfolio, some things go up, some things go down, but hopefully you haven't taken that type of hit. But those events will happen. But what we're hoping for is, by the end of the year, and everybody's, hopefully there's no wars and no other bad events. And
have you set up
the guy in the U.S. Doesn't decide to annex Canada?
Have you set up the portfolio the right way to not take the brunt of that? All right. Are you going to catch the full 10%, or do you only catch?
Well, that's the key, right? And again, I think what a lot of folks out there have to be aware of is diversification works, right? So diversify. But let's get into now some of the reasons why. So if the markets go up or if markets go down, there are some reasons why this happens. The first one here is economic indicators. And again, you look at a country and you look at the growth of a country, like what's the country selling? What's the gross domestic product of the country? And that's going to influence investors' behavior. So if Canada all of a sudden is growing the economy, that's bullish for the stock market. You've got things like unemployment rates. Again, unemployment rate changes can really affect people's spending and behavior. And of course, there's going to be inflation data. And again, nobody likes to see inflation happen. So again, if inflation does stay its course, keeps people relatively calm, more positive. But again, if we get an inflation spike, people start to pull back, and that could affect spending and could affect the markets.
Yes, exactly. And some of the other things that might be affecting the market are monetary policy changes. So interest rate adjustments, we see that all the time. Canada's come down in the last, this year, they reduced their rates a couple of times, and they're talking about maybe doing another one at the beginning of the year. That obviously has some kind of impact on the market. And the other monetary policy change might be quantitative easing, which is the government putting some stimulus into the market. And for years, they used to just keep buying government bonds to give the stimulus to the banks, like open up some liquidity. Now they're starting to tighten it a little bit, but that definitely can affect the market.
Exactly.
Yeah, one of the other things that we would look at kind of on the back of what Jason said would be how the fiscal policy develops, especially in the developed countries. So a lot of developed economies are still dealing with high debt loads, but at the same time, they're being encouraged or they're being pressured to continue to stimulate growth, right? So that's where you get this tricky environment where they have to continue to make the right fiscal policy decisions on how they spend and invest money. Mm-hmm. So, that's infrastructure projects. That might be, how are they going to increase defense and healthcare spending? So we'll keep an eye on those in 2026. And then, of course, making sure that we're investing in the right areas that are going to benefit from those policies.
Yeah, exactly. Another key thing here is going to be global events and, geopolitical tensions. I mean, right now we're living with, the invasion into Venezuela. We still have the issues with Russia invading Ukraine. So again, trade wars, military conflicts. The one thing I would say about that is it's almost like you hear a fire alarm go off. You hear it the first time, you panic, you run out of the building. The second time, you gather your things, you walk out of the building. By the third and fourth time, you're like, I'll get there when I get there, right? Yeah. So again, we're just so used to all these things happening on an evening by evening basis. I think people are becoming a little bit less worrisome when it comes to these types of events. Of course, we don't want them to happen for obvious reasons. The other thing too here is with global events is potential, a global health crisis. And again, I think hopefully we've had that one pandemic for 100 years and we're good to go. But you never know what's going to happen down the road in certain areas if there's God forbid another event like we had in 2020.
Pandemic or something.
Exactly right.
Yeah, let's hope not. Some of the other things that can influence the market, of course, are earnings report. You touched on it before. That kind of drives what a stock price does, whether it goes up or down. It's based on how the market reacts to an earnings report. It can be sector specific. So obviously there's been a lot of focus on technology stocks and AI stocks, as you mentioned, Cody. Is that going to continue on? Is there growth going to continue on? Is there earnings? Is it growing earnings? Are they starting to kind of reduce some of their earnings, and in that case, you might end up seeing a bit of a downturn. But those are key factors in how the stock market's going to perform.
Well, and I think we're in a position right now where when we look at the earnings have to continue to support the growth, right? That's going to be what continues to drive the market. But I think this year we're in a position where we need to see use cases for this AI and for this technology. It can't continue to be all about hype or just investing in future infrastructure projects. I think the market's going to react the most strongly this year to real use cases and real examples of this technology being put into place. So I think that's something we're going to keep an eye on this year, is who is benefiting the most from AI and how are they putting it into practice.
Yeah, with technology innovation, right? So a lot of companies are, like you said, are going to have hopefully an incredible few years ahead learning how to put these tools to work. Another key thing here is going to be market speculation and investment trends. And this is the one that is always interesting. This is how's the do-it-yourself investor react? I mean, we know how institutional money managers react when things happen. They're typically in buying. We know how pension funds react. They're typically in buying. Big institutions are typically in buying when things go down. But the do-it-yourself investor is
usually too late.
Maybe they're a bit afraid and they pull back. So that could be a big movement. But again. Retail investors, how do they act? But I do find now that what I've been reading is a lot of these younger investors, they're risk adverse. They're not really worried about market falls 5%, 10%. They're like, great, put more money into it. They get the fact that it's a longer term investment. There's a dollar cost averaging benefit. So the good thing is that our younger generation isn't maybe as fearful as maybe somebody who's in their 60s or 70s. So they're going to kind of keep the party going.
Yeah.
Well, they're growing up in an economy or in a stock market where, yes, it seems like every year it just continues to get better and better and better. And so I think what they're trying to understand is, how much risk do I take on? Yeah. When's the right time to take on that risk?
Or the question is going to be too, Jason and Cody, is when this does turn and there's going to be a 10 or 15% correction, are they going to be in investments where their portfolio didn't pull back 10 or 15, they pulled back 20 or 30, and then all of a sudden they have that moment where they're like, wow, okay, maybe I need to maybe even source guys like us out and find some support.
When you've had the good returns over the last couple of years, it's been hard not to make money, right? So these kids don't know yet what it's like to go through a bit of a bear or a 20 to 40% downturn.
Wow, and everybody looks like a genius in these bull market runs, right? Everybody looks like they've made all the right moves, and so then when things start to turn in the other direction, that's when you do need the calm head and a little bit of experience to be able to prevail.
Exactly. A couple other things that might affect the market this year: regulatory changes. So new regulations regarding the financial market. The guy down south seems to be opening up some regulations, getting rid of a few things. So does that impact trading behaviors? Probably increases the stock valuation. So that's a consideration. There's been lots of talk. AI has been the big driver over the last couple of years, but before that, and it is the ESG, the environment, social, and governance funds. So people want to invest in things that they believe in and that they care about, and does that make a difference in some of the stock valuations? And the answer is yes.
Exactly.
Yeah, one of the other things I'm keeping an eye on this year especially would be how, the increase in natural disasters and climate events are going to impact the market. Of course, there's downside to that, right? There's disruption to supply chains. There's increased insurance costs and rebuilding costs and those types of things. But it also opens up new opportunities, right? So if we find, companies that are investing properly in utilities and agriculture, real estate, they're exposed to those types of events. How is that going to influence their stock price and their earnings and their growth? Something we'll keep an eye on in the new year.
No, great point. And last key point here is, again, mergers and acquisitions is, are we're going to have companies start to merge and acquire new companies. That can, again, spur, stock prices to move upside or downside depending on that event. So there's lots of things out there. I think the key takeaway for 2026 is it looks like a pretty good year. We hope it's a pretty good year. We hope that, things stay calm and the world continues and there's not going to be massive disruption or challenge. And hey, if we can sit here in 12 months and say that, wow, we had a great year in 23, a great year in 24, a great year in 25, and another great year in 26. I will say with full disclosure, I always say to clients is that if you look at portfolio returns over a 10-year period, you're traditionally, on average, you're going to make money 8 out of 10 years. That's what we've seen in the past. We're seeing it with our clients. So I'm always advising clients is, hey, you're going to win 8 out of 10 times. There are going to be some events that happen that come unbeknownst to us, could change things. But again, if you're diversified, if you're in the right asset allocation mix, if you're using an advisor, you're doing it yourself, just make sure you stay diversified and don't panic when trouble comes, because within the next 12 months, we're probably going to have two or three events. All right, Cody Miller, thanks again. We'll see you next show. Great job, Jason Pollock, as always.
Thank you.
Great content as well. And for those out there, don't forget It's Your Wealth. You can find us on the Apple Network. You can find us on Spotify. We're on YouTube. So feel free to share us or to add us to your favorites. And for all those out there, we'll see you back in about 30 days. Have a great night.